You just got paid. $3,800 hit your account, and for about 45 seconds, you feel rich. Then you open your banking app 3 days later, and there's $400 left, and you have no idea where the rest went. You didn't buy anything crazy. You didn't go on vacation. You didn't buy a new TV. The money just evaporated. And the worst part? This happens every single month. My name is Anj, and I spend way too much time thinking about why smart, hard-working middle-class people stay broke, even when they earn decent money. So if you make okay money but still can't seem to build wealth no matter how hard you try, hit subscribe and like this video, because today we're exposing every financial trap that's designed to keep you exactly where you are. Here's the truth nobody wants to admit. The American middle class isn't accidentally bad with money. The entire economic system is built to extract wealth from people earning between $40,000 and $120,000 per year. And today, I'm going to show you exactly how it works, and more importantly, how to stop falling for it. Let's start with the biggest trap, and honestly, the one that frustrates me the most. Trap number 1, lifestyle inflation. You get a promotion. Your salary jumps from $60,000 a year to $80,000 a year. That's $20,000 more. You should be saving like crazy, right? But here's what actually happens. Within 3 months, you upgrade your phone because now you can afford it. You move into a nicer apartment because you deserve it. You start ordering DoorDash more often because you're busy. You upgrade from basic streaming to 5 different subscriptions. You start going out more because now you're doing better. And suddenly, that $20,000 raise has created $22,000 in new expenses. Now look, I'm not saying you shouldn't enjoy your raise, but here's what most people don't realize. Every dollar of lifestyle inflation is a dollar that never gets invested. And that $1 invested at 10% annual returns for 20 years becomes almost $7. So when you upgrade to a $20 subscription you don't really need, you're not spending $20. You're spending $140 of future wealth every month. The psychology behind this is fascinating. Researchers call it the hedonic treadmill. You think the upgrade will make you happier. It does for about 3 weeks. Then your brain adapts and it becomes normal. So you need the next upgrade to feel that hit again. It's literally designed to keep you consuming instead of accumulating. Here's the fix. The day you get a raise, before you do anything else, automate 50% of that increase straight into investments. Not savings, investments. If your paycheck increases by $800 a month, $400 goes directly into an index fund automatically. You still enjoy the other $400, but now you're building wealth at the same time. Trap number 2, the monthly payment trap. This one is sneaky. You want something that costs $2,000. You don't have $2,000, but the salesman smiles and says, "Why pay $2,000 today when you can pay just $89 per month?" And your brain does this weird thing where $89 sounds cheap, even though $2,000 sounds expensive. But here's the math nobody shows you. $89 per month for 24 months is $2,136, and that's assuming 0 interest, which never happens. With interest, late fees, and financing charges, you might end up paying $2,500 for something that costs $2,000, and you just paid $500 for the privilege of not waiting. But it gets worse, because now you have a monthly payment. So next month, when you want something else, you think in monthly payments again. Oh, it's only $100 a month, I can handle that. Then another payment, then another, and before you know it, you have $600 in monthly payments, and you can't figure out why you're always broke. This is how people earning 6 figures still live paycheck to paycheck, because their income is already spent before they even receive it. The psychology here is called present bias. Your brain values immediate gratification way more than future freedom. Buying it today feels good. Waiting feels painful, even if waiting saves you hundreds of dollars. So here's what you do instead. Start a future purchase fund. Every time you feel tempted to finance something, put the monthly payment amount into a separate savings account instead. If it was $90 a month, save $90 a month. After 6 months, you can buy it with cash. And here's the bonus. After waiting 6 months, you probably won't even want it anymore. Trap number 3, the insurance as investment trap. This one is marketed as smart financial planning. Someone in a suit sits across from you and says, "What if I told you you could get life insurance and build wealth at the same time?" And you think, wow, two birds with one stone. Except here's the truth. When you combine insurance and investing, you get terrible insurance and terrible investing. Let me show you. A typical whole life insurance policy might cost $500 a month. Over 20 years, you pay $120,000, and maybe you get back $150,000. That's a low return. Sometimes it doesn't even beat inflation. Now, compare that to the alternative. Term life insurance for the same coverage might cost $30 a month, and the remaining $470, if you invest that into a simple S&P 500 index fund, you could end up with hundreds of thousands of dollars. Same monthly budget, massively different outcome. But insurance agents don't tell you this because they're earning massive commissions on whole life policies and almost nothing on term insurance. So they're financially motivated to sell you the worst product. And here's what most people don't realize. These policies are complicated on purpose. Complexity is a feature, not a bug. The fix is simple. Buy term life insurance. Invest the difference. If you already have a policy like this, check the surrender value. Yes, you might lose money, but keeping a bad investment just because you already paid into it is called the sunk cost fallacy. Cut the loss, move on. Trap number 4, the credit card minimum payment trap. This one is a nightmare. You have a credit card bill of $5,000. You don't have $5,000, but the bank helpfully tells you, don't worry, just pay the minimum payment, which is maybe $150. Sounds reasonable, right? But here's the horror story. With credit card interest rates at 25 to 30%, if you only pay the minimum, you could spend years paying it off, and you could end up paying thousands in interest. Sometimes you end up paying double. Credit card companies are not stupid. The minimum payment is calculated to keep you in debt as long as possible while making it feel affordable. It's mathematically optimized to extract maximum money from you. And the psychological trick is genius. Paying the minimum feels responsible. You feel like you handled it, but in reality, you're making the most expensive financial decision possible. So here's what you do instead. If you have credit card debt right now, treat it like your house is on fire. Cancel subscriptions, stop eating out, sell stuff you don't use, work extra shifts. Pay it off as fast as possible, because every month you carry that balance, you are bleeding money. Trap number 5, the cheap stuff trap. This one is what I call the false economy trap, buying cheap stuff that breaks. You need new shoes. Good shoes cost $120. Cheap shoes cost $40. So you buy the cheap shoes because you're being responsible. But those cheap shoes last 3 months. The good shoes last 2 years. So over 2 years, you spend $300 on cheap shoes instead of $120 on good ones. You tried to save money and spent more than double. This happens everywhere. Cheap phones that die in a year, cheap furniture that collapses, cheap appliances that break, and every time you tell yourself you're saving money when you're actually bleeding cash. The writer Terry Pratchett explained it perfectly. The rich man buys boots for $50 that last 10 years. The poor man buys boots for $10 that last 1 year. After 10 years, the rich man spent $50. The poor man spent $100. Being poor is expensive, and the reason is simple. When you don't have much money, you think short term. You solve today's problem even if it creates tomorrow's disaster. This is called scarcity mindset. So here's the solution. Build a quality purchase fund. Save a small amount each month specifically for replacing essentials with quality versions, because quality is expensive once. Cheap is expensive forever. Trap number 6. The student loan trap. This one makes me genuinely angry because it's sold as investing in yourself. You take out $70,000 in student loans to get a degree that leads to a job paying $45,000 a year. And now your student loan payment is $600 a month. You're spending a massive portion of your income on a degree that was supposed to make you financially successful. Now, people get uncomfortable when I say this. They say education is always worth it. No. Education can be worth it, but not at any price. The real question isn't whether education has value. The question is whether this specific education at this specific cost creates more value than it takes. If you're going into debt for a degree, you need real numbers, not motivational speeches. Real job placement data, real salary outcomes, real debt projections. Because if you borrow $100,000 and your career path pays $50,000 a year, you're not building a future, you're buying a financial prison. The fix? Before taking any student loan, calculate the return on investment like a business decision. And if the math don't work, don't take the loan. Trap number 7, the social media FOMO trap. This trap is destroying the middle class in silence. Your friend posts vacation photos, your coworker buys a new truck, your cousin moves into a new apartment, and suddenly you feel broke, even though your income didn't change. So you spend money you don't have to keep up with people who are probably broke too.
And researchers found something insane. People spend significantly more money when they're regularly exposed to curated social media content, because your brain compares your real life to someone else's highlight reel. And here's the truth. Most people are faking it. That vacation? Credit card debt. That new car? 8-year loan. That house renovation? Financed. Everyone looks rich and everyone is drowning. You're competing in a race where everyone is losing. Here's the action step. Track every purchase you make for social reasons. Every time you buy something because you saw someone else have it, write it down. At the end of the month, add it up. That number is how much you spent on your ego. Trap number 8, the car payment trap. This is one of the most American financial traps of all time. People buy a car they can't afford because the dealership says it's only $500 a month, and suddenly a $35,000 car feels affordable. But what they don't mention is that $500 a month for 7 years is $42,000, and that's before insurance, gas, repairs, and registration. Cars are not assets. They're money-eating machines that lose value every year, and yet the average American is driving around with a car payment that destroys their ability to build wealth. The fix? Stop buying cars based on monthly payment. Buy cars based on total cost. If you can't afford the car without financing, you can't afford the car. Trap number 9, the rent trap. This one is controversial, but it's real. A lot of people say, I rent because buying is too expensive and I want flexibility. And yes, flexibility matters, but here's the math nobody wants to do. If you pay $2,000 a month in rent, that's $24,000 a year. Over 10 years, that's $240,000. Gone. No equity, no ownership, nothing. Meanwhile, someone with a mortgage is building equity every single month. Even if the mortgage is more expensive, they're turning payments into ownership. Now, I'm not saying everyone should buy immediately. Sometimes renting is the smarter choice, but renting is not neutral. Renting is paying someone else's mortgage, and if you rent for 15 years, you might not have anything to show for it. The fix is simple. If you plan to stay in one place long-term, run the numbers seriously, because rent feels safe, but long-term rent is one of the biggest wealth killers in America. Trap number 10, the safe money retirement trap. This one is subtle, and it keeps people broke forever. A lot of middle-class people put money into retirement, but they keep it in low-return options, savings accounts, low-interest bonds, conservative retirement funds, because it feels safe. But here's what people don't realize. Being too safe with money is actually one of the riskiest things you can do, because inflation is quietly destroying your purchasing power. If your money grows at 3%, but inflation is 4%, you're losing money every year, slowly, silently, and over 30 years, that becomes catastrophic. The difference between earning 6% and earning 10% is not small. It's the difference between retiring comfortably or working until you die. The fix? Learn basic investing. A simple, low-cost index fund strategy beats most people's complicated, safe plans. The middle class doesn't fail because they don't invest. They fail because they invest too cautiously for too long. Trap number 11, the healthcare trap. And finally, the one Americans don't want to talk about, healthcare. Because in the United States, one emergency can wipe out years of savings. You can do everything right, save money, invest, avoid debt, and then one accident happens, one surgery, one ambulance ride, and suddenly you're hit with a $10,000 bill. This is why so many Americans stay financially insecure, not because they're irresponsible, but because the system is built to punish them for being human. The fix? Have an emergency fund. Yes, an actual emergency fund. And understand your health insurance. Know your deductible. Know your out-of-pocket maximum. Because if you don't, you're gambling with your financial future. Final message. Now look, I know this feels overwhelming. That's 11 traps, and all of them are designed to extract your wealth. But here's the good news. Once you see them, you can't unsee them. And awareness is the first step to breaking free. You don't need to fix your entire financial life overnight. Start with one trap. Pick the one costing you the most money right now. For most people, it's lifestyle inflation, car payments, or credit card debt. Fix that one first, then move to the next. Because building wealth isn't about earning more money, it's about keeping more of what you earn. And the middle-class trap is designed to make sure you never do. But now you know. So the real question is, what are you going to do differently this month? If this video helped you, subscribe for more content like this, and I'll see you in the next one.